Good morning.
Good morning, ma'am.
Shall I wait to 10:30?
Okay, ma'am.
Yeah, only 4 members. Yeah. Today topic is capital gains. Audible, Amma?
Yes, ma'am.
Total 5 heads of incomes na. So in that, income from salary, income from house property, income from profits and gains of business or profession, and income from capital gains. And last one is income from other sources. So income from house property over. Now today topic is income from capital gains. This one is easy for you. Okay. So here, what is the meaning of capital gains here? Any profit and gains arising from the transfer of capital asset. Transfer of capital asset means, for example, uh, transfer of land, transfer of building, that are all comes under capital asset. So that one is affected in the previous year will be charged to tax under the head capital gains. So in this capital gain, two types are there. What are that? Long-term capital gain and short-term capital gain. So which one is comes under long-term capital gain? Which one is comes under short-term capital gain? There is some rules and regulations are there. For example, here non-financial assets. Screen share అవుతుంది కదా?
Yes, ma'am.
Yeah. Here, capital gains is two types, long-term capital gain and short-term capital gain. And in that, here, how to find out the long-term capital gain or short-term capital gain here? In the case of non-financial assets, land and building, that means land and building, plant and machinery, any equipment, jewelry also comes under this. For this, that asset, when you purchase asset after the 2 years, so when you sold, that one is considered as long-term capital gains. That means more than 2 years is long. LTCG is nothing but long-term capital gain. So equal or less than 2 years is comes under short-term capital gain. STCG means short-term capital gain. So here how many types of capital gains? Long-term capital gain, short-term capital gain. In the case of non-financial assets, more than 2 years, that asset have when after the 2 years when you sold that asset, that one is comes under long-term capital gain. And if the asset is sold below 2 years or equal, that means equal or less than 2 years, that is called short-term capital gain. So that one is in the case of where non-financial assets only. Next, what? Other than non-financial assets. Other than non-financial assets means except land and building, plant and machinery, equipment, jewelry. So for that, here more than 3 years is comes under long-term capital gain. Equal or less than 3 years is comes under short-term capital gain. So here, How to calculate the period is, see, the period of holding is counted from the date of purchase to the date of transfer. 2 years, more than 2 years, less than 2 years, 3 more than 3 years, less than 3 years. How to find out purchase of the date and transfer of the asset. Transfer is nothing but when sale of an asset. So this is the procedure for calculation of long term or long term capital gain or short term capital gain. So one more important point here, how much percentage, how to calculate tax in long term capital gain and short term capital gain. Here in the case of long term capital gain, flat rate 20 percentage, that's all. Flat rate and slab rate. Flat rate means directly you calculate that amount only. For example, you purchase land and building in 2019, 2019, okay, that asset you sold it in 2023. So more than 2 years now. So that one is comes under long term capital gain. For example, that land value is 20 lakhs. So you sold for that land is 25 lakhs. So 5 lakhs is profit now. That one is comes under long term capital gain. So on 5 lakhs you have to calculate directly 20 percentage tax. Okay, that one is called long. Hello, mute చేసుకోండమ్మా.
income tax
గాయత్రి మ్యూట్ చేసుకో. Okay, so here 20 percentage on long term capital gain, that one is called flat rate. Okay, in the case of short term capital gain, slabs only. Slab means what? For non-senior citizen, senior citizen, super senior citizen, they have some exemptions are there now, up to 2 lakhs 50,000 nil in a non-senior citizen, up to 3 lakhs deduct up to 3 lakhs no tax for a senior citizen, and super senior citizen up to 5 lakhs no tax, like that. That one is called short term capital gain. So here, what is the long term capital gain, what is the short term capital gain, how to find out, and how to pay to the tax for long term capital gain, short term capital gain. Clear? Any doubt? Audible, amma?
Yes, ma'am.
Yeah. So here, computation of so and so person. This is the procedure for calculation of long term capital gain or short term capital gain. Same procedure, but something some little bit different is there. What is that? I will tell you. So first, the table is consideration received, particulars amount. First one is what? Consideration received. Consideration received is nothing but when you sell the asset, that one is called, ante sale value is consideration received. Next, less transfer expenses. Transfer expenses means, for example, any brokerage, any commission, transfer expenses are there. Na, that one is called transfer expenses. So consideration received minus transfer expenses, you get net consideration. So net consideration is equal to what? What is the formula? Consideration received minus transfer expenses. Now, next one, indexed cost of acquisition, indexed cost of improvement. Here, what is the meaning of, first you have to know cost of acquisition. Cost of acquisition is nothing but purchase price. Okay, cost of acquisition is nothing but the purchase price. Consideration received is nothing but selling price. Okay, consideration cost of acquisition is purchase price. Consideration received is selling price. For example, Just now I told na 20 lakhs, you purchase the land for 20 lakhs, you sold for that 25 lakhs. So what is the selling price here? 25 lakhs. What is the purchase price here? 20 lakhs, like that. So next, cost of improvement. So what is the meaning of cost of improvement is any addition of the asset, any any renovation. That one is called improvement, cost of improvement. For example, you have building. In that, you add one more room or one more floor. That one is called cost of improvement. So, cost of acquisition, cost of improvement, consideration received, and transfer expenses. So, consideration received is nothing but selling price. Cost of acquisition is nothing but purchase price. Cost of improvement is any addition of the asset. So now, what is the meaning of indexed cost of acquisition, indexed cost of improvement? So indexed cost of acquisition means in the case of only in long-term capital gain. See, listen carefully. Indexed cost of acquisition is only in long-term capital gain, not short-term capital gain. Okay. Why big? Indexed cost of acquisition means, for example, you purchased the asset in land and building, for example, 1950, 1980. Now, in that, in 1950, that land value is just 10 lakhs. But same land in 2022 or 2021, the value of the land is increased. So, when you purchase the asset in 90s, that value is only 5 lakhs. Same land, that value is now nowadays some crores. So when you sell the asset, that asset value in 90s 5 lakhs na. For example, now you sell that value 1 crore, you get 95 lakhs. Okay na? So in the case of long term capital gain, you have to pay the tax on 95 lakhs. But that value, that land value in market is what? Some 90 lakhs in our example. You sold that 1 crore, you get 10 lakhs only, na? So now what is the long-term capital gain here? 10 lakhs. Without indexation, 90 lakhs, 95 lakhs. But with indexation is how much? Only 10 lakhs you got. So that is the reason in long-term cases, only in the case of long-term, you have to calculate indexed cost of acquisition and indexed cost of improvement. Is it clear? So in the case of short-term capital, no need to calculate indexed cost of acquisition, indexed cost of improvement. This one is very, very important. So first step is what? That asset is comes under long-term or short-term. That asset is comes under long term, you have to calculate indexed cost of acquisition and indexed cost of improvement. If the asset is comes under short term capital gain, no need to calculation of indexed cost of acquisition and indexed cost of improvement. Just you calculate cost of you take cost of acquisition, cost of improvement. That's all. So next, what you from net consideration, you less indexed cost of acquisition, indexed cost of improvement, you get capital gain. Now here, after that, some exemptions are there. Exemption under section 54, exemption under section 54B, you get taxable income from capital gain. When you get the taxable income from capital gain, on that you have to calculate 20% flat rate. That one is called flat rate. On long-term capital gain, how much tax we have to pay? 20% flat rate only. In the case of short term, just to have to find out the person is comes under senior citizen or non-senior citizen or super senior citizen. Like that, you have to calculate slab basis in the case of short-term capital gain. This is the procedure for calculation of capital gain in the case of short-term or long-term. Okay. So yeah, take the pick for cost of acquisition here. And here capital gain also is there. Capital gain is equal to selling price of the asset minus cost of the asset. Cost of the asset is nothing but purchase price. In the case, loss means what? Purchase price is more than to the selling price. That's all. Transfer expenses, example, see here. Selling expenses, brokerage paid, etc. Are the same is to be deducted from the sale money received. Sale money selling price of the asset means sale money. That's all. Okay, no confusion. Okay, just you write like this. Capital gain is equal to selling price of the asset minus cost of the asset. Capital loss is equal to cost of the asset minus selling price of the asset. Okay, now?
Yes, ma'am.
Now,
Yes, ma'am.
here cost of acquisition. Some years are there. This one is very, very important. Cost of acquisition is nothing but what? Purchasing price. Acquiring the adjust. That means purchase price. See here, purchase price. And expenses incurred after purchase till its first use. This one is not important. Leave it. So here, if the assessee has any construction or manufacturing the asset, then all expenses incurred by him on its construction or manufacturing will be taken as cost of acquisition only. So here, if the asset is purchased before 1st April 2001, see the date, this date is very, very important. If the asset is purchased before 1st April 2001, the cost of acquisition is actual cost or fair market value of 1 for 2001, whichever is higher is the cost of acquisition. Is it clear? Once again, I repeat, when, see, when the asset is purchased before 1st April 2001, in that case, the cost of acquisition is equal actual cost or fair market value, whichever is high is the cost of acquisition. Okay. So after 2001, in the sum they given the purchasing price, na that one only cost of acquisition. That's all. Here 2 points are there for cost of acquisition. Okay. Now, one more important point. If in the sum they given any stamp duty value, in the case of where land or building are both, if stamp duty value is available, then fair market value of such land or building or both, that means land or building or both, 1 for 2001 shall not be exceed the stamp duty value. That means fair market value not exceeding the stamp duty value. In that case, the asset is purchased before 2001, actual cost or lower of the following means fair market value or stamp value, whichever is least, you have to take that one, actual cost or lower of the following two. Whichever is high is the cost of acquisition. So this procedure is what? How to calculate cost of acquisition. Here two important points are there. When the asset is purchased before 2001, after 2001, that one is. Next what? In this sum, in the sum, if they given stamp duty value, you take fair market value or stamp duty value, whichever is least, that one should be, you have to take. In after that actual cost, that amount whichever is higher is the cost of acquisition. In the case of only stamp duty only. So here now how to calculate cost of acquisition, you know. Next what? Yeah, you take this pick also. This total in this table, that asset is comes under long term, that gain, not asset, that gain is comes under capital gain, short term capital gain or long term capital gain. See here, in the case of types of security, her period of holding for short terms under. That means nothing but period of short term means this more than is comes under long term only. So here listed securities other than unit 1 year. Within the 1 year, that one is comes under short term. Next, units of equity oriented fund, unit of UTI is that one is comes under first 1 year. That one is comes under short term. Zero bond coupon bonds also 1 year. Unlisted shares 2 years. Land and building are both 2 years. Units of debt oriented fund 3 years. Units, unlisted securities other than shares, 3 years. Other capital assets, whether financial or non-financial, 3 years. So 1 year, 2 years, 3 years are less than equal. That means 1 year or less than 1 year. That one is considered as short-term capital gain. More than 1 year, 2 years, 3 years. That one is comes under long-term capital gain. Okay. Take this pick also. Okay, now?
Yes, ma'am.
Yeah. Here you see, in the case of long-term capital gain, here some indexation, inflation index has notified the government under the government rules only have to follow the indexation. So, in the case of long-term capital gain, you have to calculate indexed cost of acquisition and indexed cost of improvement. Na? So, how to calculate indexed cost of acquisition, indexed cost of improvement here? In the sum they given purchase when asset is purchased. For example, asset is purchased 2002 to 3. Cost of inflation index is how much in that here 105. In the sum only they given, but you have to uh, previous year index you have to know. What is the previous year index here? 21, 22, 317. Okay, 21, 7, 31, 21 to 22, 317. Take this pick also. Okay, okay, now?
Yes, ma'am.
Yeah. Now you see how to calculate indexed cost of acquisition, indexed cost of improvement. 1 minute. Yeah. See here, transfer of index cost of acquisition under section 49. In the case of self-acquired asset, if the asset is purchased and transferred by the assessee, calculation of indexed cost of acquisition is two headings are there. First one is if the asset is purchased by the assessee before 1st April 2001. 1st April 2001 is very, very important in capital gains. Okay. So what is the situation here? When the asset is purchased before 1st April 2001, how to calculate indexed cost of acquisition is, this is the formula. Original cost or fair market value of the asset on 1/4/2001, whichever is higher. See here, original cost or fair market value of the asset on 1/4/2001, whichever is higher, into previous year index. Just now I told na previous year 21-22 index is how much? 317 na. That previous year index divided by 100. This 100 is statutory amount only. Okay. So what is the situation here? When the asset is purchased before 1st April 2001, original cost or fair market value of the asset on 1st April 2001, whichever is higher, into previous year index divided by 100. This is the formula for calculation of indexed cost of acquisition when asset is purchased before 2001, 1st April 2001. Next, what if the asset is purchased by the assessee after 1st April 2001? So just you have to take here original cost of the asset into previous year index divided by index of purchase year. Index of purchase year means what? For example, you purchase the asset 2004. So what is the index when asset is purchased? 113 na? 113 you have to take here. Where? Index of purchasing year. Previous year index, 317. So previous year index divided by index of purchase year. What is the difference between, see here, when asset is purchased 1st April to before 1st April 2001, after 1st April 2001? See here, when before 2001, you have to take here original cost or fair market value, whichever is high, previous year index divided by 100. But here, original cost of the asset into previous year index divided by index of purchase year. This is the difference between if the asset is purchased before 2001, after 2001. So next, what if the asset is acquired under special mode of transfer? That means not self-occupied. Not self-occupied is nothing but in the business oriented. That one is comes under special mode of transfer. So if the asset is acquired from the previous year owner, here sales transactions are there now. So before 1st April 2001, previous owner acquired this asset before, ante owner or previous year owner also, that asset is acquired. Acquired is nothing but purchased 1st April 2001. In that case, original cost or fair market value of the asset, whichever is high, into previous year index divided by 100. Next, in the case of second situation here, owner acquired the asset is after 1st April 2001, but previous owner is acquired before 1/4/2001. In that case, original cost of the asset or fair market value, which into previous year index divided by index of first year in which asset was held by the assessee. That means present owner. Here, whichever is higher is here only. So whichever is higher, that amount value index you have to take here. Next, owner and also previous year owner also acquired the asset after 1st April 2001. Just you take here original cost of the asset into previous year index divided by index of first and each in which asset is held by the asset. That means present owner asset indexed value. So here total 5 steps. In first 2 steps, if the asset is self-occupied mode, the asset is acquired before 2001, after 2001. Next, what other than self-occupied and special mode of transfer, the asset owner and present owner and previous owner before and present owner and previous owner after. In second point, previous owner is after, but present owner is before. Okay, take the pick. You have to learn this. Clear?
Yes, ma'am.
Yeah. Next. Yeah. This is the procedure now, how to calculate long term or short term. Here, in the case of short term, there is no need to calculate indexed cost of acquisition, indexed or only directly you take cost of acquisition, cost of improvement only. Now you know the consideration received, transfer expenses. Consideration received minus transfer expenses is net consideration. After that, you have to calculate in the case of long term capital gain, indexed cost of acquisition, indexed cost of improvement, and after that you deduct the under section 54, 54B. I will tell you which one is comes under 54B, for 54 and 54B after the one question. 1 minute. See here. Screen share అవుతుందమ్మా?
Yes, ma'am.
Yeah. Here, Mr. Suresh purchased an art piece of Mughal period for 6 lakhs on 9th July 1999, and 1,48,000 is spent for glass frame and illumination with elective lights in October 2009. He sold the asset for 36 lakhs. Okay, during the previous year. If selling expenses are 29,000, calculate capital gain for the current assessment year. Cost inflation index is 2009 and 10 is 148. See here, when asset is purchased here on 9 July 1999, so yeah, 1 minute. So during the previous year, October 2009, he collected 600. First, you have to calculate consideration received. Consideration received is nothing but what here? Selling price. So he sold the asset for how much? 36 lakhs. So consideration received is how much? 36 lakhs. Now let's transfer expenses. Transfer expenses is how much here? Here for capital gain, the current asset. If selling expenses are 29,000, nothing but transfer expenses. So 36 lakhs minus 29,000, you get 35 lakhs 71,000. This one is called net consideration. Okay, consideration received minus transfer expenses is you get net consideration. After that, this asset is comes under long-term capital gain or short-term capital gain. So now you see here transfer of asset. What is the asset here? Asset is what here? Artwork. So from the assessment year 2018-9 onwards, artwork is considered as capital asset. This one is very, very important. After the assessment year 8 to 9 onwards, that artwork is comes under capital asset. So the this asset is when he purchased this asset 9th July 1999. When he sold this asset October 2009. Sorry, previous year. October 2009, that one is cost of improvement. Cost of improvement is nothing but here see 1,48,000 is spent for glass frame and in illumination with elective lights in October 2009. So here more than 3 years. So that one is comes under long term capital gain. In working notes you have to write like this: transfer of asset. When he transfer of asset, previous year only, when it is purchased. So purchasing year and purchase year compare with the previous year. So more than 3 years you consider as long term capital gain, less than 3 years you have to consider as short term capital gain. So in the case of long-term capital gain, you have to calculate what is that indexed cost of acquisition. How to calculate indexed cost of acquisition? What are the points are there? Before 1st April 2001, after 1st April 2001. So before 2001, what is the formula here? Original cost or fair market value of the asset on 1st April 2001 into previous year index divided by 100. If the asset is purchased by the assessee after 1/4/2001, original cost of the asset into previous year index divided by index of the purchase year. So here the asset is purchased before 2001. So the asset value is what? Purchase cost of acquisition is nothing but purchase price. So 6 lakhs into previous year index 317 divided by 100. You get 19 lakhs 2000. So cost of acquisition is 19 lakhs 2001. When you deduct from the net consideration, you get 16 lakh 69,000. Now, what is the cost of improvement? Here, what is the meaning of cost of improvement? Add any addition of the asset. That one is considered as cost of improvement. So, cost of improvement is how much here? 1,48,000. See here, 1,48,000 is spent for glass frame in art. This one is Mughal periods of art. So that art is lights, and they add lights and glass frame. So that considered as cost of improvement. So how to calculate cost of improvement means here, just for example, I will share this. 1 minute. Yes, this one only. Cost of improvement is nothing but 1,48,000 into 317 by 148. 148 is the that index number is equal to 3,17,000. See, in the sum only they given index number 148. 2009 to 10, 148. So here improvement is how much? 1,48,000. Now what is the expenditure? That one is called cost of improvement. Cost of improvement into previous year index divided by which year that improvement is made, that year index you have to write. That is the reason here 1,48,000 into previous year index divided by which year that cost of improvement is made, that year index you have to calculate. So 148 is the 2009-10 index. That is the reason 1,48,000 into 317 by 148, you get 3,17,000. So when you deduct from the 16,69,000, you get 3,17,000. Now you get income from capital gain is how much? 13,52,000. On 13,52,000, you have to calculate flat rate 20% tax directly. This is the procedure for calculation of long-term capital gain. Okay, now? Now, some 54, you have textbooks now?
Yes, ma'am.
Okay. In your textbook for a cost of acquisition, cost of improvement 243. Okay, what is the capital asset? 241, 243, 245. And index also they given 340, 249. Okay. And 54. Yeah, for 54, just two deductions only important. Profit on sale of property used for residency under section 54 and urban agricultural land 54B. That one is important. What is the meaning of that means here? When you receive the capital gain, that means for example, you purchase the house in 2019. Previous year when you sold, that one is considered as long-term capital gain. Within the 1 year, you purchased one more residential house. In that case, some exemptions are there. So within the 1 year or 2 years, when you purchase one more asset from that capital gain, that one is considered as under section 54 deductions. And next 54B is here, when capital gain on transfer of urban agricultural land not to be charged in certain cases, that when in the case of agricultural land, that one is considered as 54B. So just you read out page number 252, 253. That's all. Okay. Now, How to calculate total income? Just I share one more pic. You copy this. You copied all this sum?
Yes, ma'am.
Okay. I will share for 54, 54B one table total.
Ma'am,
Yeah.
can you share this problem?
Where? Take the pic na.
No, ma'am.
Yeah. Take. For 54, 54B, I have one table also. I will share you. You take the pic. See, this one is for 54. Under section 54 is exemption from capital gain. That one is self-occupied residential
Ma'am, the
purpose.
screen is not shared.
Yeah, not share. Now,
No, ma'am.
ah, now,
No, ma'am.
now,
Yes.
yeah. See, for 54 is what individual or HUF only in the case of residential house. That one is let out or self-occupied. So purchase or construction of two houses for residential purpose in India. Least of the two is the exemption from tax. So what are the time limit here? Purchase of the house within 1 year before or 2 years after the date, and construction the house within the okay, take the pick this, and after that I will share uh 54P also. Or yeah, this one is 54B. Okay. Vera, over.
Yes, ma'am.
Next one, income from other sources. I will share one more pick for income from other sources. This one is a theory question, important theory question. See, which one is comes under income from other sources? Yeah, see here. The following are some of the important items. That one is calculated under the head income from other sources. First one is what? Interest on securities. Any interest on securities when you received, that is considered as income from other sources. Next to dividend on preference shares. When you purchase the shares, you get the dividend na, that one is comes under income from other sources. Any interest on debentures, any winning from card games or lotteries, crossword puzzles, and see, rent or hire charges received by letting of plant machinery, rent from subletting the house. Subletting means what? When you give the rent, and again one more person have to give the rent, that one is called subletting the house. Royalty in the case of mines, you received the royalty now, that one is considered as royalty received. Director fees, examination remuneration received by a teacher, any remuneration received by a teacher for examination purpose, that one is considered as income from other sources. And agricultural income from foreign lands, and rent from lands, commission received, that means chit fund commission or any insurance, interest on securities issued by a foreign government, remuneration received by MPs and MLAs. Just you have to by head. For long question, what incomes are comes under income from other sources? Just you write these points, so you get the full marks. Okay. So interest on loan given, examination remuneration received from employer not in the master of the assessee or form from any other person or institutions. Interest on income tax or any other tax refunds, like that you have to read out. Take the pick for this. In your book also is there.
268, ma'am. Page number.
268. Collection of tax. Which book you have?
Ambedkar.
168, not 268. Interest on security 167, 168. Okay. Yeah. Next class, I will tell you income from salary, and I'll give you important
Ma'am, we
questions.
have this in 268.
In your book?
Yes, ma'am. I will
Yes,
share
I will
on
share.
268.
Okay,
Okay,
okay.
okay.
Okay, you have now? Yeah. Any doubt regarding?
Total 24 points ఉన్నాయి ma'am.
Yeah. Out of 24, just you read out 15 or 20. Okay?
Okay, ma'am.
Yeah. Any doubt in capital gains?
Hello. Yes, ma'am.
Hello?
Yeah. So the difference between short-term gain and long-term capital gains is this: short-term comes under less than a year and long-term above the years, right?
Yeah, that's all.
Okay. Is this dividend taxable or not?
Dividend?
Dividend and this you have explained the last, right? Directory fees.
Yeah, that
Are
one is
these
comes under
taxable?
income from taxable income from other sources. That one is comes under income from other sources. Not
Okay.
in the
Are these all
not in the
taxable?
head. Ah,
Okay. Thank you.
today I will tell you I told for you income from capital gain and income from other sources. First part is income from capital gains. So next
Okay.
part is income from other sources. So income from other sources, what are these 24, 25 points? That one is considered as income from other sources.
Ma'am,
Total five heads of incomes now.
Yes.
ma'am,
Yeah.
I shared the 24 points in the chat box. Can you once check it?
Yeah, this one only, na? Hello?
Yes, ma'am.
And
Share
this is
out.
under section 56 to 59, ma'am. Income from other sources.
Yeah. Okay. Same. These points only. These are all comes under income from other sources.
24 points, ma'am.
Yeah.
In that we have write total 24 points in examination.
No need to write 20
20. Okay, ma'am.
theory question for this. Okay.
Okay. Okay, ma'am.
Yeah. Any doubt in capital gains? Now you know the
Ma'am,
short-term
what is the
capital.
question for this answer?
Yeah, yeah.
What is the question for this answer, ma'am?
What is the
Question.
question? What are the income from other sources? Write down income from where, which one is comes under income from other sources. Okay.
Okay, ma'am.
Yeah. Any doubt in long-term capital gain, short-term capital? You concentration on how to calculate index cost of acquisition, index cost of improvement for long-term capital gain. In short-term capital gain, just you have to take cost of acquisition, cost of improvement only. No need to calculation of index cost of acquisition or index cost of improvement. One more important point, that asset is acquired before 2001 or after 2001. Okay.
Okay, ma'am.
Yeah. Yeah, index last year only have to concentrate previous year index, that one is 317. Before that previous year they only in question only they given, no need to worry. Okay. One more in income from other sources, just you I had that 24 out of 24, just 20 points. That theory question is compulsory, very, very important. And in income from house property, last class, that let out house property and self-occupied house property, when they given fair market value, municipal rental value, standard rental value, actual rental value, you uh, find out the actual rental value, and when they given a standard rental value, how to calculate gross annual value, that one is very, very important. So long questions, income from house property, income from capital gain, and residential status sums, three sums over long problems, and income from other sources, theory question over. Next class, I will tell you income from salary. So income from salary, I will touch important points, and how to find out the income from salary. There are some 6 7 important points are there. Next class I will tell you. Okay.
Okay, ma'am.
Yeah. Any doubt?
No, ma'am.
You take the pics now.
Yes,
All
ma'am.
the pics.
Ma'am,
Yes,
can
go.
you show once the problem of the capital gain?
This one, no? Not
Yes,
this.
ma'am. Working notes.
Working notes. Okay.
Mm.
Cost of improvement, just calculating cost of indexed cost of improvement, that cost 1,48,000 into 3,317 by 148. I will share that one also.
Okay, ma'am.
1 minute. Not clear, I think this one. Just calculate cost of improvement 1,48,000 into 317 by 148. You get 3,70,000. Okay.
Okay, ma'am.
Yeah. Clear?
Yes, ma'am.
Shall I close?
Yes, ma'am.
Yeah. Any doubt?
No, ma'am.
Yeah. Next class I will tell you. I think next class is the last class.
21st.
Ah.
ఓ మ్యామ్ ఇంకా 2 క్లాసెస్ ఉన్నాయి.
21st and 28th also.
28th also is there?
ఎస్ మ్యామ్.
Okay.
దిస్ మంత్ టోటల్ 3 క్లాసెస్.
Okay. Okay. I will take.
అండ్ నెక్స్ట్ February 26 ఎగ్జామ్స్ మ్యామ్. 26.
February 26th. Okay.
26th.
Okay. Okay. Okay, na? Bye.
Okay, ma'am. Thank you.
Yeah. Bye.